Hey there, everybody. Diamon, J.P. CEO, came out with a warning that there are some very, very serious headwinds ahead for the U.S. and the global economies in the coming months. He noted that U.S. consumers are still holding up relatively well comparatively to other times leading into recessions, with consumers spending 7 to 9% more in Q1 of this year compared to last year, and 23% more than in pre-pandemic times. He sees $1.2 trillion more of excess cash or consumer savings, and believes the rise in credit card debt is only normalizing. Although he noted that the terrible battle in the Eastern Hemisphere, geopolitical tensions with China, the political divide in America, and the global leadership role of the United States being challenged by outside forces places the U.S. square in the middle of a time of great crisis. With the massive market uncertainty, he finds it likely that lenders will become more conservative, reducing liquidity in the markets. He also sees the increase in spending being inflationary, which could lead to persistent inflation and cause the Fed to raise rates higher than most people are thinking, despite all the bank failures. J.P. Morgan just came out with a report stating that they believe the Treasury yield curves in the United States are so inverted, and that the United States is in such a recessionary environment from the Fed beating up the market so violently with their 4,000% increase in the federal funds rate, that the Fed ordinarily would have already cut the federal funds rate if the macroeconomic factors around inflation were not so unusually bad. They said it's hard for them to predict a sustainable bull case in the near-term future, considering we are already running headfirst into a recession, noting that the market will likely have a strong risk-off reaction if they do not see at least a hint of a pivot by June. Since there is a lag of around 6 months between the time a rate hike is implemented and the time that the rate hike is felt, it's likely that we've only felt the pain of half of the rate hikes that have already happened. They are concerned that the Fed may have already over-tightened, and any further rates would only push us deeper into a recession. J.P. Morgan believes that the solution for investors is to hedge their holdings by shorting market upside, since they see an asymmetric risk in the near term for the stock market. I am by no means a financial advisor, although personally I do have holdings in SDOW and SQQQ just in case the market does shoot down in the near term, which will limit my downside risk and lower the volatility of my overall portfolio. Stay safe out there, guys.